Jorian, thanks for being here today. I'm excited about this episode we're going to record.
Yeah, thanks for having me on. Excited for the conversation.
Yeah. So as well, you told me in our previous conversations about your fundraising experience and your job of helping founders through their fundraising process. Can you maybe get us started with like understanding what you do for founders, how long you've been doing it for, and what you like about it as well?
Yeah, for sure. So I'm a startup fundraising coach, and so I help founders run high quality fundraisers. And what that means is I support them through the preparation and execution phases of their fundraise. And so I help them prepare really well. I help them with strategy. I help them create a storyline, investor list, kind of all the things that go into preparation. And also during execution, I become someone that they can call and ask questions as they're talking with investors as new questions are coming up. And so I'm really the support throughout the fundraise to help them run a high quality one.
And that's different from let's say a brokerage firm or somebody that runs their fundraisers. Like early stage founders and CEOs should run their own processes, right?
That's right. Yeah. My belief is that founders should be the ones kind of running a fundraise. And so I like to put founders in the driver's seat. I'm not fundraising on behalf of them.
Yeah, yeah. But I think it's also because it increases their chances, right? Like especially angel rounds, like early stage VC rounds, they want to see the CEO conducting the actual fundraise, right?
Yeah, not only do they want to see the CEO, but at the earliest stages, I would argue an investor is mostly betting on the team
Yeah,
in many ways. And, if the team is unable to present and talk to investors, that can be a red flag.
yeah, yeah. But indeed, they've never maybe done it before, and there's so much to know about the process and so many questions that might pop up that having like the support of somebody that has run a number of them is quite valuable.
Exactly. Yeah. First time founders, they're not sure what they don't know. And so there's a lot to fundraising. I don't think it's rocket science, but there's some things you want to do well. And then also, I have some founders who are multi-time founders and they fundraised before, but they tell me, "Hey, Yorian, I fundraised. I know how to do it, but that wasn't a lot of fun. I wish I had some help. I wish I had a sparring partner." And so I've helped in
Yeah,
those cases too. Yeah.
yeah. Yeah, and I think like also solo founders or founders where the founding team only has maybe one person that is knowledgeable about these topics, they benefit a lot from somebody to talk to, somebody to talk through the common problems that come up or like specific situations.
That's right. That's right. It can be lonely too, because as a CEO, a founder, who do you turn to? Yes, you can turn to your existing investors sometimes, but that can be quite vulnerable. You can ask other founders, but other founders, it's hard to get on the phone with them, multiple times a week and really be there for ongoing support.
Yeah, yeah, no, I can totally see that. So I think, well, that's super interesting for I think every founder to know. So I think the idea today is to try to understand more about the fundraising process, understand your experience with it, and how you help founders. Kind of pick your brain on those topics, and hopefully give people some sort of a master class to how to fundraise early stages. I know your focus has been in the US most of your coaching career so far, but I think the best practices there apply everywhere.
Yeah. Yeah, let's dive in.
Nice. Okay, so let's say I'm imagining like what's the first thing that you tell founders when they become your clients? Like how does your sort of teaching quote unquote process happens when a founder is a first time founder or the first time the founder is?
Yeah, I would say the way it begins is I really try to emphasize treating fundraising like a project and
Mhm.
a work stream you're working on. I think sometimes there's this temptation just to do fundraising kind of in the background, or you're putting together some materials, you're starting to talk with investors, but there's not really some direction. And so I really encourage founders, and I help them with this, think through what are the different elements you want to prepare in order to have a high quality fundraise, and then how do we sequence the actual fundraise process, those investor conversations, to try to get some FOMO going, to try to get the best deal possible. So that's how those engagements often start is through that strategic
Yeah,
lens.
so explaining them that it's a process, that there is a maybe like a timeline to follow, some things to prepare. So if we kind of follow that timeline, I would imagine you start with preparing some documents, right? Pitch decks, financial projections, maybe.
Yeah, maybe even one step before that is, and this is often before folks will work with me, but it's something I encourage founders if they're talking to me and thinking about a fundraise, is answering that question, are you ready to raise? And how much do you want to raise? What is it going to be used for? Are you a good candidate for venture capital? I think answering some of those questions before you dive into the materials can be really beneficial because they can help guide kind of what that story needs to look like, and also what creating the investor list and so on
Yeah.
looks like as well.
And is there like an ideal way that founders can figure that out? Because like we speak with a lot of them, right? And when it's the first time that they do the process, it's very hard for them to figure this part out, especially.
Yeah. It's really, really tough. I would say the best resource is probably trying to talk to other founders who have gotten different funding sources and trying to understand, which of these buckets do you fall into. I'd also encourage founders to try to think through, especially if you're at the early stages, what are your hopes and dreams for this business? Are you trying to build a kind of household name, something that could be $1 billion or €1 billion company, right?
Mm.
Or are you trying to create a really successful $50 million company, which is an amazing, amazing outcome, but is less suited for venture capital?
Yeah.
And so trying to understand, what does that dream look like? Because not every founder even wants to build that large
Yeah.
company.
Yeah, for sure. And they don't have to, right? Despite the fact that like in the press, a lot of the times you find this, like the press is very single-sided on these extreme outcomes, but they don't have to. And sometimes actually with dilution and with everything, like a smaller outcome where you keep more of the equity might end up personally better for some founders.
Absolutely. I have a couple founder friends where, kind of in confidence, they'll tell me, hey, I've raised 40, $50 million. I have 30 million in annual revenues. They're doing quite well, but because of all the investment they've taken on, they
Yeah.
really need to keep growing this thing for a good outcome. Now, they're not just doing it for the outcome side. They also want to build a good business, but I don't think they realize kind of all the restraints it was going to put on. So
Yeah.
understanding that before you dive in is really
Yeah.
important.
Yeah, super. Yeah, it's it's a long topic, right? We could probably do an episode only on that. But indeed, like venture capital and just equity fundraise comes with some expectations of returns, and you need to make sure that those expectations are aligned with your own before jumping onto basically a marriage where the goals are completely different between founding team and the investors.
That's right. That's absolutely right.
Nice. And how do you go about, like, let's say, okay, they've decided that's the outcome they want. They've decided a venture capital is the way to finance that the strategy. How do you go about determining like what kind of amount they should be looking for and whether like the milestones that they have are reasonable for fundraising that type of
Yeah, so typically at the earliest stages, you want to look at what milestones you're trying to hit kind of 1 and 2 years out or so. Typically, people are fundraising for two-ish years of runway, maybe 3 or so. And you really want to think through what kind of funds do you need to actually hit those milestones, right? And then make sure there's enough buffer in there as well. And
yeah.
that's where talking to other founders or looking at other examples can be really helpful, because sometimes what can happen on that back of the napkin math is you'll say, okay, well, we need to add these features and we need to add this go to market. And so I need, and we're going to hit 2 million revenue. And so I need 3 developers and I need 1 salesperson. And if you then talk to someone who has a company at that size, they'll tell you, I'm making these numbers a little bit up, but no, gosh, you really need double that and those engineers and
Yeah.
triple the salespeople or something like that. And of course, this is changing a little bit with AI. But my message is you don't want to undershoot on how much money you need, because otherwise then you'll come back and need money much sooner before you've even been able to hit milestones.
Yeah.
And so when you're thinking about how much to raise, there's definitely a part with the milestones. And then there's also some market reality of how much how much is the market willing to give you? If you need
Mhm.
5, but the market's only willing to give you 2, you might need to make a plan for 2.
Yeah.
On the opposite end, if money is really kind of easy to come by, if we're in a ZERP area or something like that, maybe you don't want to overraise, but maybe it's worth grabbing a little bit of extra money while it's quote unquote cheap.
Yeah. 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 And this idea of milestones, meaning like try to raise enough in order to achieve enough milestones so you can raise the next round, right? I feel that's already something that founders are not really extremely aware the first time that they raise capital.
Yeah. Is there a mistake or two you often see kind of when founders are deciding how much to raise?
Yeah, well, one thing we were chatting about is we get a lot of calls from companies that are trying to raise right before or with the purpose of launching their product, but the launch is like 2 months, like a month or two, right? And like, yeah, that's the incredibly difficult process of trying to raise something before a major milestone, right? Every investor is gonna tell you like, oh, we're just gonna wait and see, and you should also be waiting and seeing, and because like according to how that launch goes, you're gonna have so much more information to set the strategy to maybe do a fundraising in a different way and so on, and just make a much better personal and company decision on what to do for the future. So I always tell them like, yeah, this is not the best way to do it, but then normally when they get to me when they're doing valuation like a month before the launch or 2 months before the launch, it's already too late because they're going to run out of capital before the launch, or they're not going to have enough capital to do a proper launch. And so at that point, it's quite late to change things.
Yeah. And I don't know if this is too much off topic, but one idea that just came to mind there is you want to, if possible, fundraise with enough runway left. And one of the things you can do in that situation is, let's say you only have 4 or 5 months of runway, and so you're thinking, no, shoot, we need to fundraise. It might be worth trying to do a little bit of an angel round and trying to shore up some of the fundraising. You don't always need to think about fundraising as doing this whole big round or not doing it at all. Because you're right, if you try to do the big round right before you're about to hit a couple milestones, not only are you leaving money off on the table by not seeing the results of those milestones, but also investors are going to wonder, hey, why are they? This is a little bit of a red flag that they need money right before they're
Yeah.
about to launch something.
Yeah, 100%, 100%. Yeah, indeed. And that's actually one of the cases where we normally tell people like a convertible loan at that point is like a fantastic instrument, right? Because you can, like, you already know that you're going to need money in 6 months or so, like after the launch, like no matter how it goes. And then at that point, like this type of bridge loans that can convert into equity in the next round are a great instrument. Yeah.
Absolutely. Something like that, or a safe,
Yeah.
some more lightweight instruments can be really helpful in those
Yeah.
scenarios.
Nice. And so you were mentioning like raising, so trying to look for an amount that covers your next 2 to 3 years, right? I normally shoot for like 18 months or something like that. So kind of like 12 months plus 50% because you never know how things are going to go. I did hear during the super high ZERP era, 2022 or something, during a workshop, somebody that was absolutely convinced that they should raise for a runway of 6 months because they should raise every 6 months.
Yeah.
And that sounded to me like, okay, there's definitely a bubble. So you're thinking 2, 3 years, right? Like that sort of length of time horizon.
I'm thinking 2 or 3 years. I saw some, I don't have it in front of me, but some data from Peter Walker at Carta earlier this year that the time between rounds has been increasing kind of over the last couple of years. From, if I remember correctly, it's been from 18 months ish to 2+ years.
Okay.
And so with that, I just want to make sure people know that sometimes that next round doesn't come as soon as you think. So,
Interesting. Yeah. Yeah.
and there's exceptions, of course. I mean, I still know people who are raising rounds every 6 months. And sometimes if you're growing really fast, if you're on the cutting edge of AI, that could make sense.
Yeah.
But boy, you're staring off the edge of a cliff every time
Yeah.
you do that, but if you're
Yeah.
raising huge amounts, sometimes that's, you'd rather do that than take a much lower valuation earlier on.
Yeah. If you're growing super fast, but indeed, like I'm quite glad that we're talking about this because it feels like if you are just exposed to news, right, you are exposed to the top like 10% of companies, right? Maybe even a smaller percentage. And then you don't realize that like the vast majority doesn't behave like that. And that's extremely fine, right? And maybe those companies didn't behave like that for 15 years until they did find their own strike, like, their own gold vein, and then they went after it. But yeah, like there is a lot of irrational pressure, I believe, on founders, um,
And
because of this selection
yeah.
of
And
past cases.
I would take it even one step further. There's the ones that hit the news. That's maybe that 0.1% or 1%. And then even founders who just even raise from venture capital in some ways are the exception, right? Because it is hard to raise from venture capital.
Yeah,
And so sometimes what happens is if you just have friends with people who have raised from VC, you can start to think that is the normal startup or so.
yeah,
And it's the normal VC startup, right? But it can skew your mind also on what is easy versus what is
yeah,
hard, right?
100%. Yeah, yeah. We just did a study, which I believe was one of the first ones, looking at the percentage of companies that want to raise angel capital and they actually succeed, right? And it's quite of a difficult thing to do, because how do you communicate the intention,
Yeah.
right? So we looked at companies that applied for funding to an angel network, and like what percentage of those got funded, right? And it's roughly between 3 and 7%. So it's extremely difficult to raise that first angel capital. And then after that, I believe I forget the specific, but I think between 10 and 20% that manages to raise a first VC round. So you look at the companies that did raise the first VC round, you're already looking at like 0.3% of all the companies, of all the founders you see around, right? So yeah, super interesting.
Yeah. Yeah. And I don't want to overly scare folks also because, if you have a good background, it could be that you're a great fit for VC also. And so there's
Yeah,
a fine balance between, putting some fear in people of like, hey, this is quite hard, but also there are some folks where, hey, you could be a great, great candidate for VC
yeah,
funding also.
yeah. No, for sure. It's possible, but it's not as easy as it looks like if you're just following TechCrunch and those
That's
kind
right.
of things.
That's right. That's right.
Yeah. Nice. And that, this is why we do this podcast, right? To try to even the odds between people that do have the knowledge or the means to access that knowledge and people that don't yet. And, we're distributing this everywhere, and hopefully a lot of people are gonna listen to it.
Absolutely.
Nice. Okay. So you've decided that you have more or less an idea like how much you want to raise. You have an idea of where do you configure yourself in the buyer's world as well, right? Are you like roughly a pre-seed? Are you like completely out of the schemes and you need to look for some different solution, or are you configuring yourself as a Series A or so on? So what are the documents at that point that you help founders walk through?
Yeah, absolutely. So at the beginning, once they've decided how much they want to raise, who they're getting funding from. So let's just say for now that's VCs or angels. I recommend they start preparing their pitch deck and also their investor list. And I recommend they do those things in parallel. The pitch deck I recommend start with first, because it's really about, can you get your story down? And I think story is so critical
Yeah.
in fundraising. And then the investor list, I'd love to see founders create a robust enough investor list where there's maybe 100 plus VCs
Mm-hmm.
or angels on there that they're researching. It can take a lot of tedious work, and we can get into that, so that there's a lot to draw from. And then
Yeah.
there's other documents you start making with the data room after the pitch deck, et cetera. But those are the two things
Yeah.
that I recommend starting with.
Yeah. And those are probably the ones that take a lot of time as well, right? And investor list, trying to have companies or people that you've already spoken to, maybe like previously, maybe at events, maybe they noticed you or something. And then also people that you fully don't know at the moment, maybe.
Yeah, exactly. I think there's two ways to think about how to get connected with VCs. There's either you take an offensive kind of route and you say, okay, these are the VCs I want to find intros to, I want to get connected with, right? And you still might do that in a natural way, and you might add to it based on who tells you VCs that founders recommend you add to the list. Or you can instead say, I'll just meet with whatever VCs people are recommending, kind of whatever come my way, whoever I meet at events, conferences. And my worry with that second method is you might miss a lot, and you might not realize who are the best VCs possible for your kind of situation.
Yeah, because it's just like kind of reflecting who's on top of mind at the moment, or whoever wrote to you in the past 2 months that you can still remember or something, rather than trying to follow like a systematic process of hitting everybody.
Exactly. And would it be helpful if I detail a little bit like how I think about what a really strong investor list would look like?
Sure. Yeah.
Yeah. So in its most ideal states, I'd love to see kind of over 100 investors on there. As long as you're at the earlier stages. If you're at the later stages, it might be that, only 30 or 40 investors are potentials. Over 100 plus investors. And I'd love to see that kind of tiered in some way, where the top tiers are the ones you're most excited about and that can really lead the round. And then as you go down the tiers, maybe they can still lead the round, but you're a little bit less excited about them. And then maybe that's followed by folks who can't lead, but you're excited about, and
what's the percentage of them that should be in that top tier?
I would think about like, can you do groupings of 20 to 40 VCs or so? So like if you have an investor list of, let's say, 120 VCs, maybe there's roughly that are 30 that are tier 1, 30 tier 2, 30 tier 3, 30 tier 4 that you have. But the more that you can get in those tier 1s and tier 2s, the better, of course.
Yeah. And like, is there like a heuristic on how many should be like sort of warmer already? Should you have done events before in order to meet them? Should you have answered the associate that got into your email, or is it okay if they are like 99% cold?
Is it okay if they're 99% cold? It varies so much situation by situation, right? Because some people come in already with this strong VC network.
Yeah.
Some people come in with not a strong VC network, but they've gone to places like Stanford, or they've worked at a Palantir, or they have these kind of natural networks that can connect them. Some people have decent networks, and then some people are coming in with no networks at all. And so you have everything kind of on that spectrum. What I would say on whether to choose a VC, if they're a good fit, is if you're already warmly connected and they're at all a decent fit, that's a great one to have pretty high on that list.
Yeah.
But I'm totally okay with you having VCs on there that are totally cold. And we could talk a little bit about strategies of how to turn that cold into a warm intro. Because I'm not one of these people who will yell and say you can't do cold outreach. But I would say, if you can work like heck to make that a warm outreach, and there's ways you can do that, all the better.
Yeah. And sometimes people don't even Google the fact that the specific investor is going to be next to you tomorrow for an event or something. And they miss out on that chance, and they would rather send the automated email.
Or a simple LinkedIn search to see who your mutual connections are. I can't count how many times someone's told me, hey, Jorian, I don't have any connections to VCs. And I say, okay, great. Let's pull up LinkedIn.com. And I have them type in the VC, and there's like 40 mutual connections or so, or maybe not even 40, maybe just 5 or so. And 3 are junk connections, but 2 are really good.
Yeah, one is your previous flatmate, and
who's very happy to connect you, unless you stole all their snacks.
He had a successful exit already, and he's been seen as a genius by the VC, and he can run around on his own. Yeah, no, it's true. It's really true. I feel like this. Sorry.
Oh, go ahead. Sorry.
No, I was just like thinking about this network fact is maybe a bit less felt in Europe, just because the networks are less entrenched and less developed. There are still networks, but because they are so scattered, maybe that's less important in the process. Like it's a bit easier to do cold outreach, let's say, or to have a lot of leads that are colder and still get good outcomes.
Yeah, I don't know if I've seen that or not. Yeah, I've worked mostly with US, but also a decent amount with European startups. And I think networks still matter some, but yeah, maybe it's easier than in the US. I think in the US, the volumes are so much higher that some of these
Mhm.
VCs, they're just getting thousands of reach outs,
Yeah.
and so they need some sort of sifting mechanism.
Yeah, that seems to be kind of the case everywhere. That like I know, for us for Equidom, we do collaborate with VCs that use us for valuations, and I've spoken with a bunch of other software companies that are in the same sort of market, and a lot of them had this idea of helping VCs filter through applications, and I've talked to with a bunch of VCs, and they really sorry, not that they want to send more leads to VCs, and most VCs are not interested in receiving even more leads. They already have troubles screening through the ones that they receive. So,
Yeah,
yeah, that's true for sure.
yeah, absolutely. I just wanted to return just one other comment on the investor list. One of the reasons it can be so tedious, but I think that tedious work can be really helpful, is you might even want to get to the level of detail where you know which partner at the firm would be the best fit for you.
Yeah,
There's no one place you can go for a magic list. I always recommend people, go to Crunchbase, but they also go to PitchBook if someone has access. They also go on these sheets that are floating around. They talk to other founders because
yeah,
your VC list is going to be different than my VC list if I was fundraising. And
yeah,
by the way, they change every year or two because funds run out of money, they change, there's new GP, all these things. And so all that to
yeah.
say it's a lot of work, but it's worth putting in the work.
Indeed, indeed. Um, yeah, and yeah, you can easily go to like who's the right partner, but even like trying to guess like what are their interests. Everybody these days has like a few videos on YouTube, right? Like
Yeah,
how do they talk? Do you even like them, right? Because like they might end up on your board.
right.
You might end up having to deal with them on a monthly basis, and yeah, if they're not if they don't vibe with you, maybe like that's not the case, or maybe they vibe a lot, and then you can have a much more enthusiastic reach out, and it helps a lot. Yeah, no, it's quite interesting. Nice. No, so okay, so and that's already like a lot of work, right? And I feel like this is never advertised, right? It's never advertised that you need to have a very long list, because everybody wants to make it look like they raised without any effort, right?
Yeah.
That they were the best company, that it just took them like 2 days to raise, and so on. So this is super helpful to know. And the other thing is a deck with a story and stuff, right? And I guess sort of going through a good deck is like out of the scope for today. But what do you see that like what is the advice that you're tired of giving whenever you receive a deck?
Yeah, luckily I like what I do, so I don't get tired of giving the advice, which I feel lucky for. But what I recommend if you're thinking about making a pitch deck is it really should be one cohesive story. And so I always recommend start making the pitch deck not in slides. Just start it in a Google Doc or start it wherever you can just write down things. Write down, what are the 10 to 12 to 14 core slides you want, and then write maybe the titles and write just the key takeaways, and then scan through that, maybe even show that to someone and ask yourself a couple questions. One, when you read through kind of every slide by slide, just those couple bullet points, does it read like a story, or does it
Mhm.
read more like every individual slide is standing on its own and not coming together like a story? And second, are you really presenting your startup as the hero in this story? Right? At the early stages, you're trying to get an investor to take a bet on you. Yes, that you can execute in the short term, but also that you have some big dream that you can go achieve, right? And that you're just a little bit crazy to go after that. And so, is that pitch deck sharing that, okay, this startup is really solving this problem and is the hero kind of in this story?
Yeah, yeah, indeed. And like, I always wonder, so you always have some things that maybe are not stellar about the company and you have to put them in, but you kind of never know where, right? Like, is there a,
What do you
like,
mean? Like some things that aren't stellar, but yeah.
like say that, say that a startup has, well, very little traction these days is gonna make it very, very hard to raise. Let's say maybe a team that is not, like, that, is like subpar for some reason. Maybe they don't have any big logos on their
Yeah.
CVs, right? So like, where do you wave that into the
Yeah, that's a good point. So I would differentiate between, you know, is something just not quite a strength, or is it more of a skeleton in the closet, right?
Mhm.
Because it's one thing if the founding team, hey, you don't have the biggest experience ever, right? But there's ways to still share that story on the pitch deck. Or is it that, there's some baggage there or something like that,
Yeah,
right?
yeah,
In which case that's a different scenario. Let's just say it's kind of, you don't have as strong of an experience, you don't have quite those logos. You still want to answer, why is this the right team, right? And maybe rely more on experiences that show that you're able to lead and
yeah.
that you're able to do something special, right? So sometimes I've seen founders, maybe they haven't led a company before or had an exciting role, but they won some national championship at something, or they are super dedicated to this other thing, or
Yeah.
they've researched this space kind of in and out and are able to quantitatively show that. If
Yeah.
you're able to just give a little bit of color to who you are and why someone should bet on you, I think that that's really important. And I would say on the traction example, if you don't have the best traction, what can you share? What are the leading indicators that you can point to? And how can you tell a story around that? And then
Mhm.
the other thing I would say is, like, this comes back to the, are you ready to raise? It might be that when you look at all these things and when you look at your traction and the team and all these things, you say, shoot, we have to go back and do some homework, or maybe we have to get some initial angel funding from people who really care about us and are
Yeah.
willing to take that earlier bet.
Yeah, indeed. Yeah.
Sorry
So
for the
that point, like,
long
when
answer.
it gets too big,
There's a lot
no,
there.
no, no. When it gets too big of a negative, then you might have to actually do some work and change it,
Yeah.
like, some actual hard work. Yeah. No, fair enough. Fair enough. No, no. It's a good. It's a great answer. I think in the end, yeah, you're trying to present the company in the best light, like in a best realistic light, in a very, like, to kind of polish it up and show the best self of the company. And then it's a competitive process, right? So like, this deck is gonna be compared with another 100 or so,
Yeah.
and then the top 2 or 3 are gonna
Yeah.
receive a follow-up call, or like the top 10 are gonna receive a follow-up call, and then the top 2 are gonna receive funding, right?
Yeah.
So
That's right. And have you heard of like Y Combinator's fundraising vertebrae before?
not really.
So, yeah, it's this idea that you take a step back and you think through, what are your 3 to 5 kind of fundraising vertebrae? And what they mean by that, and I recommend this to founders I work with, is if an investor were to invest in you, what would be the 3 to 5 biggest reasons that they would invest? And for some people, the team is in there or the traction's in there, and for others, it's not. But
Hmm.
when you come up with those 3 to 5 points, those end up being the things that you hit again and again through the pitch deck, through your
Yeah.
Q&A, through the storytelling. And that can really help, because then you lean more on your strengths,
Yeah.
right? And weave that into a story, rather than thinking, hey, the story is a collection of 13 points that all need to be incredibly solid.
Yeah, and they all need to, like, it's a series of check boxes, right? And we get this question a lot of, like, okay, what milestones do I need to hit in order to raise, like, this amount, or in order to raise the Series A in this specific industry, and so on. And like, the reality is that because it's a competitive process, there isn't like a checklist, and the right way to think about it is not really like a checklist of hitting all the boxes, but stressing your differentiators, be
Yeah,
able to be on top of the selection, let's say,
yeah,
and those are the ones that get funded. So yeah, this is a great way to shift the focus of the founders from trying to check all the boxes to
yeah,
actually stressing their strengths.
yeah. That's the One thing that will get me riled up, and I see this a lot online, is this kind of checkbox idea that if
Yeah,
you just were to hit all these checkboxes, then you would get funding. And
yeah,
that's just not how it works.
yeah, indeed.
People raise based off story. And story is not just this magical thing that's made up and is Willy Wonka. Story is based off hopefully real things, but it's a story nonetheless, and it's why someone can believe in you.
Yeah, yeah. Well, the believability of the story depends on like what has been done so far. That's one of the major differentiators that differentiates one company from another.
Absolutely.
That's the whole value of milestones, right? So
Right.
one of the gripes that I have with early stage decks is that like sometimes you go through the whole thing and like some incredibly important milestones are not mentioned. And maybe they are achieved, maybe they're not, but they're not mentioned at all, right? So you get to the end of the
Right.
deck and you're wondering whether the product has already launched. You're wondering whether like the team is full time or not, or whether they started 2 years ago or 5 years ago, or these type of things. And I always tell founders like, look, if like the only thing that makes this not like just a story on paper, just a Walt Disney movie, is the fact that some of these things actually happened, right? So everything that has happened, you need to try to fit it in somehow. Like maybe in a side note, maybe instead of saying like we'll have 10 customers, say like this is our current funnel, and we have 0 customers, but we have 10 conversations ongoing, right? So those conversations are actually happening. Mention them, right? So
That's
yeah, so
right.
that's my biggest thing on decks.
Yeah. Yep. And I think one useful question when you're thinking about your pitch deck is if an investor were to just scan through it for 30 seconds, which by the way happens a lot, and maybe then once they've scanned through it for 30 seconds, if they like it, they'll go back and read it for 5 minutes. But if they do the 30-second scan, do they understand the core ideas of your startup? Or do
Yeah,
they come out still wondering what in the world is this product? Do they have customers? Is the thing launched? Why is this team special? And that's why, having the titles be aligned with your key takeaways, having good visualizations, having good design, all those things are important.
yeah,
Yeah.
yeah. I almost think about it as trying to make like a company is an abstract entity. The digital services are extremely abstract, and that's like 80% of fundraising, right? So then like when you put it on a deck, like it all feels extremely abstract and extremely not concrete, right? And what I try to visualize is like the investor is going to try to visualize the company as a concrete thing, right?
Yeah.
So ideally, if you do have like a factory, like put a picture of it, right? Like the more concrete you can make what you are making, um, the better, in my opinion. And like things like, okay, we are a team of 10 people, maybe you have a picture of the team, or maybe even the team in the office, right? Or we have this type of customers, you put like their logos, or maybe like a picture of a case study rather than just mentioning it in the text and things like that. Like it all helps to make something that is just a representation of a company into like an actual company, in my opinion.
That's right. That's right.
Super nice. Okay. Yeah, there's a lot of
Oh
detail
my
on
God.
these
We
things.
could go like 4 hours here, I'm sure.
Yeah, I think like the next natural step though, which I think is like fundamental, and that's actually one of the main things that I wanted to get to today is how do you like look at the timeline of a fundraise, right? So we talked about step one, okay. Like how long does that take? When do you start contacting investors? How does the scheduling work of the round?
Yeah, that's right. So the creating materials, creating the investor list, we didn't talk about some of the materials, but anyways, all that can take usually minimum 2 months, kind of up to 4 months. It
Mhm.
can happen quicker if you really have your ducks in a row, and if you're a hot startup,
Or if you have to.
or if you have to, right?
Yeah.
But typically it's 2 to 4 months, and that's all the way from the beginning questions of are you ready to raise, right, etc. So that 2 to 4 month period, but then you actually want to move into actually having conversations with investors. And I'm a big believer in parallel tracking some of these things. So while you're making some of these materials, while you're making the investor lists, I would love for you to, in the later stages of that, be having some conversations with investors, whether they be VCs or angels or whoever your target is, to test how is that working and get a lot of those initial questions out of the way. Because
Yeah.
what you don't want to happen is to have everything perfectly wrapped up, feel that you're ready to fundraise, and then say, and we can talk a little bit about how to run a great process, meet with 45 investors in a 2 week period, only to find out by the fifth conversation, shoot, they're asking questions I'm not prepared for.
Yeah.
I want to make some changes in the deck, and now it's a
Yeah.
little bit too
My
late.
story is wrong. Like maybe some milestone, I still need to achieve some milestones even maybe. Yeah.
Exactly.
Yeah. Yeah. Yeah, that's super true. But yeah, okay. So you have those conversations towards the end of this, like say 2 to 4 months. And maybe one thing to stress here is that 2 to 4 months might sound long, but that's the reality of it, right? You have a day-to-day job, like making a deck that is perfect, thinking through these things, discussing them, making a proper list with like the proper connections and stuff takes time on top of your day-to-day, right? So the company
Yeah.
needs to go on while this happens,
Yeah.
and so like 2 to 4 months is very realistic. It's not
Yeah.
what you find on TechCrunch, but it's
Yeah.
the reality.
And let's talk about the 2 months one, for example, right? Because that might sound like a long time, but that's actually relatively fast because let's say you were going to start on September 1st or so, right? You
Hmm.
might be able to put all the materials and investor lists together all within 1 month, right? But now you need to get intros into those investors,
Hmm.
and that can take a few weeks as well. And so that's sometimes kind of what can add to that timeline.
Yeah, yeah, for sure. It's 8 weeks. Like 2 months is 8 weeks, right?
Right.
So you reach out to somebody like that you want their feedback on your deck, and like they are off for a week, and they schedule with you the week after or something like that. And yeah, it's very easy to get to 2 to 4 months. Okay, so you've done that, and so towards the end of it, do you talk with a few investors that maybe like already or maybe not, and like just to get some initial feedback, just to make sure that there aren't any major issues with your proposition, let's say? And is that the point where you start also getting these intros, just to, so like how does the rest of the timeline look like?
That's right. So yeah, you do these kind of, I call them like sneak peek meetings essentially with VCs to see how those are going, right? And as a quick aside, if you have the luxury of lots of time, and you're thinking, hey, I might want to fundraise a year from now, you might actually start doing some of these coffee chats, getting to know VCs earlier. I don't want that to take over your job by any means, right? Because job number one is to build the product and sell, right? But
Yeah.
you might start some of that networking earlier. But anyways, back to your question, right? How do you get intro to all these VCs? How do you kind of kick off this process? So if we return to that investor list, let's say that had 120 names on it. What I would love a founder to do is what I would call intro mapping, right? Where they're going fund by fund through almost that entire list of 120, or at least the top half of it, and
Mhm.
trying to figure out what their intros are. And the number one way I would do that is just through LinkedIn. If you just search the fund in the search bar and then click people, and then you can click kind of second degree connections, you can find a lot of folks that way. And again, ideally,
Mhm.
it's that partner that you actually want to get connected to. So if you make that big list of all the potential introers, you can then reach out to those people and say, hey, get them a little bit jazzed about your startup and your fundraise. Maybe bring them into the fold and say, hey, I see you're connected with this person. Might you be able to make an intro? And if they
Yeah.
say yes, what I actually recommend is a little bit counterintuitive, where you say, thank you so much. Can I take you up on that in a couple weeks? Or can I, let me kick things off in a few weeks?
Yeah.
Just because someone offers an intro doesn't mean you need to take it right then and there. And if you hold off, what that allows you to do is really make sure you have a lot of intros happening all at once rather than
Hmm.
sporadically. So I'll pause right there. That's kind of strategy number one. If you can actually get those intros, I can also talk about like, what if you're looking through that VC list and you're not able to find intros? I can talk through some strategies on that side as well.
Yeah, no, and that's interesting, but I think like until we like finalize the process, then it's difficult to visualize like what is this all for?
Yeah.
Because I think what you're leading to is like you need to get to a point where you're running the fundraising campaign for a short time, but very, very intense.
That's right. That's right. So yeah, let me touch on that. So ideally, you've had those sneak peek meetings. So you have a good sense of like, are VCs or investors biting or not, right? And you'll know if they're biting. I would then love for you to kick things off, and in a ideally 2 week period, you are doing dozens of meetings,
Yeah, as
right?
many as you can. Yeah, with all the list, like hit everybody. Yeah,
Yeah. And at that period is when fundraising does turn into a full-time job. And I would not recommend running your business in parallel. I mean, maybe you have to do it a little bit for sure, right? You have to keep serving customers, but that's where you really want to rely on a co-founder, your team, et cetera, to help you
yeah,
out.
yeah,
So now you're fully kicking off with investors, doing as many meetings as possible. That allows a few things. It allows you to generate, hopefully, some FOMO, fear of missing out, right? Among these investors, because just naturally your schedule is going to be more busy. There's going to be more people trying to get after the deal. And also, you're going to be fully in fundraising mode, and it's going to give you confidence. If you're talking with 45 investors in a 2 week period, you will feel more confident in your messaging, but you will also feel more okay if investors say no, because it'll feel like a pipeline to you. Whereas if you're doing things sporadically, if you're talking to a couple investors per week, every no hits you so hard.
yeah, yeah. And it happens a lot that no's are from completely, like, extremely strange reasons, right?
Yeah.
So it's extremely unpredictable to understand whether somebody's gonna say no or yes in this type of things. I feel like normal traditional sales, you can expect things, you can qualify, you can do a lot. Unlike fundraising and M&A, it's like, oh, there's a company there's an investor or a buyer that I never heard of in like Austin, and we never spoke before, but it turned out that they're extremely excited about this, and they just happened to sell their own company like a month ago, so they have the cash right now, and it kind of all aligns. And in the same way, it could be that an investor just saw a similar deck the week before and they didn't like it for some reason, and then they say no to your deck as well. So having that perspective of like, oh, I still have 10 potential yeses on the list, like not all is lost, really helps handling the 90%, 95% rejection rate that you're gonna get.
100%. Yeah, you
Yeah,
can't know exactly why they might turn to no's. And as you also said, like, you'd be surprised sometimes which firms end up stepping up to the plate and want to take a swing at that.
yeah. Also, simply because you cannot know every firm, right? And yeah, or every partner. Or awesome, yeah. So you try to concentrate everybody in like 2 weeks, something like that, so that you can really minimize the impact on the business of this process.
Yeah, an initial meeting within 2 weeks, and then hopefully you're then running the process kind of over the course of, I would say, 6 to 12 weeks or so, right?
Yeah,
So the 2 week period is the initial meetings, and then there's going to be follow up meetings as well,
yeah,
hopefully leading to a term sheet kind of between 6 to 12 weeks.
yeah,
Maybe sooner if you're a very exciting deal for sure. And then there's time for closing, et cetera. Once you move to closing, that's where you can also get back to kind of running the business or so. Closing can be a pain, but you're able to at least you're only talking with one party at that
yeah,
point.
yeah.
One of
That's an episode on its own.
Yeah, and yeah, for sure. And one of the reasons the big investor list comes into play, because you might have heard me say the number is kind of 120, and then maybe you're having kind of 40, 50 meetings, right? And you might think, hey, what's happening with those other VCs? One strategy you can do is kind of top up the investors you're having initial conversations with
Yeah,
if too many are starting to drop from the pipeline, so
hmm,
that you're continuing to kind of hit quote unquote that top of funnel
yeah.
in weeks 2, 3, 4 of fundraising. Um,
Okay.
if not enough people are kind of moving through your process.
Yeah, yeah. And that's actually my question was, what's the latest that you allow somebody new to come into the process?
What do you mean by that question?
Like I imagine, like, you start a process, word gets out, right? But somebody is like on holiday or something, and then they realize that somebody tells them, like, let's say 3 weeks into that process, that you're fundraising, and they reach out and they're like, hey, we just heard you're running a fundraising process right now, we'd like to be part of it. Like, what's the latest time that you allow them to come in, or
Yeah.
you just always allow them?
So I would distinguish here if they're a lead versus like a follow-on investor. If they're a follow-on investor, then you can be more chill with when they come on because they could throw in some additional capital later on. If they're a lead investor, I wouldn't want to bring them in too late
Yeah,
because I've heard multiple times from a VC where they said, hey, an exciting founder came to us where we maybe wanted to get into the deal. Maybe they didn't think it was the next Stripe, but they were still excited nonetheless. But they already had a term sheet, or they're moving towards a term sheet, and the VC just said, hey, this is moving a little bit too quickly for us. We don't have time.
yeah, yeah,
So
indeed.
VCs can move very quickly, usually, but you don't want to wait. I would say you want to at least bring them in, a week or two before you're getting a term sheet at the latest.
Yeah, yeah. So like you are, let's say, fairly deep in conversations with like other two potential lead investors, and like you're kind of discussing the later terms. That's when the term sheet is like 2 weeks out. Let's say that's the latest that you bring in like a new party in the same role.
Yeah, at the early stages, right? And here's where it matters so much. Are you raising a pre-seed seed series A
Hmm.
versus are you raising a series B, C, D, right? Because series B, C, D is generally going to be harder to bring someone in very late in the process
Yeah,
because they need to
yeah,
go through the data room, they need to get comfortable, they need to meet the management team. There's a lot
yeah.
more things they really want to do. At the early stages, I've seen some seed deals go, in a day or two
Mm.
because essentially the VCs just need to talk to the founders, do a couple reference calls, and they can move.
Yeah,
Yes, they might be on vacation in Mallorca, but there's still internet service down there. So,
yeah.
um,
Fair enough. Yeah, and then it's just a standard like safe, and yeah.
yeah,
Awesome, awesome. Okay, yeah, that's really overlapping with the yeah, the processes that we normally encounter. Well, not that we normally encounter, that we normally suggest, right? This is
right.
kind of the state of the art, and this is really what maximizes your chances of fundraising. And I think a lot of the 93 to 95% that we were saying before that doesn't manage to raise pre-seed, like there's a large percentage of them that doesn't know about this process, that doesn't follow it, or that for some reason think it doesn't apply to them, because it's a ton of work, right?
Yep.
It's a ton of work, but it's also one of the largest transactions that you're gonna do. So like it has to be a ton of work. It's a very competitive process
Yeah.
and so on. So you need to give yourself the best odds, and this.
Yeah. And make sure, by the way, on that ton of work, don't let things slip through the cracks. You want to make
Yeah,
sure you have, and it can be a simple Google sheet, honestly, or you could use a lightweight CRM. But
yeah,
have a Google sheet where you're keeping track of all the conversations, all the to-dos, because I promise you, unless you have a perfect memory, if you're talking with 45 investors, there's going to be lots of follow-ups. There's going to be a lot of, wait, when did they last respond to this email? There's a lot of things you
yeah,
need to keep track of that are
yeah.
easy to forget about if you don't have them written down somewhere.
Yeah, and there isn't an easy way to do that, or at least like for me, that's incredibly hard to keep track of and to be consistent with. But I think that's also why you're trying to manage this in a short period of time, right? Because it feels like, okay, like you add everything up and it's like 6 months, let's say, or maybe more.
Yeah, four
That's
to
not.
four to six
Yeah, from
months
the
like that. Yeah,
from the thought of like, oh, I need capital, to the actual
right.
capital hitting the bank, like, right, 6 months or more. And it feels like, okay, this is a lot of time. This is the shortest. Like, this is, I think the
Yeah,
the practice that has been made by practitioners that have been doing this multiple times, and they've seen that this is the quickest time, the one with the better odds, and the one that doesn't affect the business negatively, or at least minimizes the negative impact on the business of a fundraising process, right?
yeah.
Yeah, because you're going to be distracted for so long. It's a tough process. Yeah,
Absolutely. And time is money, right? So if we break fundraising into two parts, preparation and execution, The preparation part is the part you can kind of fully control, right? Like it's making the pitch deck, the investor list, trying to get connections. Like you can do that work. The execution piece, you can just give yourself the best chance of running the best process. The
Yeah.
market will decide how quickly it kind of ends up moving, but you really want to make sure you're giving yourself that best chance so that the process can move quickly as opposed to slowly, because otherwise you're prolonging the amount of time before you get money in the bank and before you can
Yeah.
start getting back to what matters, which is building and selling.
Yeah. Indeed. Then maybe like, what's like, when do you, if it doesn't go well, when do you call it quits? Like, how do you call it quits in the best way possible? Because that happens as well.
It does. And there's some internet lore out there of, okay, you've just got to talk to 200, 300 investors out there, and then you'll find the right one. And I'm not going to debunk that, because there's some truth to, fundraising is a long game, and many founders have that experience of talking to 100 or 200 plus investors.
Yeah.
So last thing I want to say is, don't do that. However, if you are getting repeated feedback where in your heart of hearts you're like, that is true, and it's something you need to go fix in the business, then if you hear that 30 times, 20 times, something like that, that might be a good time to pause, because that might be something you need to go fix, and you might need to find a different way to get funding, right?
Yeah.
Also, another reason you might kind of quote unquote call it quits is the time side of things, right? You might be going after a larger round via VCs or angel groups or whatever. But if it's dragging on, that's all time that you can't be building. And so at some point you might need to think, can we raise a smaller amount? Can we bootstrap? Can we do something different to try to get some of those milestones going
Yeah.
and get back, and then maybe raise in the future? I don't know.
Nice. Yeah.
What do you think there?
Yeah, I think that's a great idea. The way that I think about it through the valuation lens is, if you can standardize the feedback under the lens of risk and return. Normally, you can receive different feedback, but then it all communicates the same thing, right? So if it's about, for example, the vision is not big enough, the market is not big enough, the number of customers not big enough, like feedback like that, it's about the return, right? So you need to find a way to shape the story and the company, because the story again is based on the company, right? So you need to find a way to shape the story and the company to actually be able to have that bigger vision if you want to raise venture, if you want to raise angel type of rounds. If the whole feedback is like, you need more traction, or like, we need to see more certainty, or we don't believe you're going to be able to achieve this growth, like these type of things, then it's all about the risk part. And again, you might have to, but I really like your model. Like, okay, you find that consistent feedback, you see that it's not something that's about how you communicate the story, because sometimes it's just about how you communicate it, and you need to
Yeah.
learn about that and always adapt. But if it's not about that, then yeah, that's a great sort of heuristic to think like, okay, I might need to take a step back, reconsider the whole thing. And probably if you sort of maturely communicate it to the people that are currently in the funnel, you might have a really good outcome when you go 6 months after to fundraise again. It's like, hey, this process taught us a lot. It taught us that our traction is not there yet. I'm sorry, but for now we'll regroup, and we'll go after that, and we'll reach out
Yeah.
again when we're ready.
Yeah.
Like that's a fantastic way to do it. Always easier said than done, right? Because when you're in it, like, you feel it, right? You feel it on
Yeah.
your skin. But yeah, that's a great way.
Yeah. And you'll often hear the next best thing after a yes is a quick no, right?
Yeah.
And if you can get a lot of no's quickly, that's helpful to get that feedback sooner.
Yeah.
And
Nice.
if
Maybe
if
to
for me, I'd prefer for you to get that even during those sneak peek meetings. That's part of why I recommend those.
yeah, maybe to get us back on a positive note. Is there like an interesting like fundraising story that you have where like maybe like the process will run very well, or just maybe like a real story of like what happened?
Yeah, absolutely. So yeah, I can bring that in so many different directions. What kind of story do you think would be interesting? Because there's a lot that come to mind.
I think the a real story of somebody that ran this process. How did they do it? What did they find difficult? And how did it go in the end?
Yeah, yeah, perfect. So a friend, and I'll keep this anonymous, but they're kind of in the legal space, was recently fundraising, and they did a good job of, for about 6 or 8 weeks, building up all the materials and kind of shopping those around with friends. They worked with me. They had some current investors, and so they got good feedback on that and really got a good understanding of, are these materials are going to land or not? And
Yeah.
they got confidence on that. They also worked their butt off to really create a curated investor list. And one of the things they did well was they were quite open with how they put that together. So I think they drew from 10 plus sources or so, and they had an
Mhm.
investor list that was nearly 200 VCs deep,
And
right?
like serious and targeted and like
Curious and
open
target.
to invest in their space. Yeah.
Exactly. And they had a lot of notes written for each one. And I think they
Mhm.
actually used Perplexity, which I love, for getting some additional details on
Yeah.
focus areas and so on. What they were then able to do was, for their top couple tiers, they went into their network, not only their existing network, but they started dialing up founders, because founders generally love to help other founders, and asking for help, asking for intros, etc. And they were able to get some of these intros very warmly into these VCs,
Mhm.
where people were messaging these VCs saying, hey, you've got to talk to so and so, it's really cool what they're building. And this founder, they did a great job of getting um, people in between them and the investors really excited.
Mhm. Yeah.
So then when they went to fundraise, and by the way, they also had a buttoned up kind of data room, they had a financial model ready to go, they had the other documents ready to go, the due diligence stuff, all that. When they went to fundraise, they were able to then have a lot of conversations with VCs all at once, because the people making the introductions, they kind of told them to go all at once. So they
Yeah.
had about 65 meetings in a 2 week period, right?
Was it in a specific location or were they present to these meetings or was it a lot of
They
calls
were
and
in San Francisco. The first meetings were all on Google Meets or
yeah.
so. But then some of the second and third meetings were then in person in San Francisco, and they also flew over to New York for a few of these meetings
Uh-huh.
as well.
That's a busy couple of weeks.
It's a
65
busy
counts.
it's a busy couple weeks. Yeah, so the 65 were all online, and then
Mhm.
it trickled down. And what happened to them was kind of what you were mentioning, where it was kind of a complete surprise of who went through the funnel. And
Yeah.
so, of the firms that they thought were kind of sure bets, like half of those moved through, and then half were no's, and those were really
Yeah.
surprising. And then there were a few dark horse firms that also kind of came through.
Nice.
And then, just to kind of finish that story, that culminated in 3 term sheets. And the power, and if we talk about the goal is to get multiple term sheets, because then you can play them off of each other,
Yeah.
not only to get better terms, but also for you to figure out who is the best VC you want to work with.
Yeah.
Right. And so through that, they were able to negotiate some of the term sheet terms, and also find a partner that they really liked. And they did most of the negotiations, if not all, prior to signing the term sheet, so
Yeah.
that then when they closed, it was a relatively clean kind of process
Yeah.
from there on.
Nice. Yeah. And this is, I mean, I imagine their legal background helped in that case.
It did. It did. Yeah. So they were familiar with it, and they were in good conversations with their startup lawyer beforehand of,
Yeah.
what is all the due diligence you need to do.
Yeah.
So
That's
that
also
was an
great.
example I saw recently of a friend who did it very well, the
Yeah.
whole fundraise process.
And just the 3 term sheets, they would be with 3 potential leads, right? And then the follow like investors that identify themselves as like followers, they would just come in whichever lead VC would be the chosen one.
That's right. So the lead VC was the most important piece. The good news is at the earlier stages, if you get a lead VC and they're writing a pretty big check, it's relatively easy to get follow-on VCs that want to come through. And so then they were able to get those in the process as well. And I think they were very strategic about which VCs they wanted at that point. Because once you have your lead, you don't need to take more money from other people. And so you want to be very selective on why am I bringing this person on?
For sure.
Not
Yeah,
just
yeah.
they bring money to the table.
Yeah, well, especially if the lead can cover the whole amount, then interesting,
Yeah.
interesting.
And
And
there's some
yeah,
negotiations that happen there because if you actually have too many people interested, um, it it can become a little bit of a like school fight amongst the VCs of how much allocation they get. And you
yeah,
do want to be a little bit careful there as a founder because if you get your round over allocated, you could be giving up more dilution than you
yeah,
initially hoped for. So obviously, it's a good problem to have, but it is actually a problem a lot of high quality founders run into where they
yeah.
start saying yes to too many people and give away too much dilution. I don't know if you see
Yeah.
that also, but yeah.
Oh yeah, yeah, for sure. Like the and we haven't touched on valuation today because there are too many things. But like yeah, like the way that we think about it is always trying to balance the dilution based on the idea that you're gonna have to retain enough equity to have incentives to be with the company through thick and thin. So if you end up giving away too much of the company in the early stages, and like you increase the risk of like founders splitting up and so on, lowering ultimately the probability of success of the company. So you see it with like specific companies that are really hyped, right? And it happened in the past already, especially through the ZERP years, and now with like AI companies, that people don't think too much about, okay, what kind of dilution and also what kind of pressure this type of hype is going to bring to the company, and is it actually beneficial? It's flattering, it's nice, it's you like, there is this idea that like more capital, more good, right? And it's so hard to stop oneself there when you have the honey jar in front of you, right?
Yeah.
But it can be very detrimental, and there is actually a ton of research over the fact that more capital is not more good. Like more capital is actually very detrimental to the success rate of the
Yeah,
companies. So yeah, it's definitely something to think about. Again, easier said than done.
absolutely.
Yeah, when you're in the situation. Yeah.
And you mentioned we haven't talked about valuation. I just wanted to ask you about that. Like, obviously, you have a lot of different types of founders that are using Equidem, but when you come across a founder who's running kind of a high quality kind of fundraise process and they're using you guys, like how do they usually leverage kind of the products they get from you to really
Yeah.
help them in that high quality kind of process?
Yeah, the goal, like the best way, the best tips, right, are in that preparation phase, right? You're thinking about how much to raise, you're thinking about your story. At that point, you should be thinking also about your valuation, right? And what using Equidem in that stage allows you to do is it allows you to figure out that risk and return balance, and like whether with this type of growth, like this type of valuation is justified, and the other way around, what kind of growth would justify a certain valuation, right? So that's kind of super helpful to give you feedback on whether the strategy is realistic and whether like a certain amount of capital would make sense for a certain type of company, right? And
Yeah.
this is surprisingly useful even at very early stages, where like of course projections at that stage are more strategy than anything,
Yeah.
but it still allows you to understand that stuff, and it allows you to communicate how ambitious the company is, right? Because everybody has a different definition of it, and if you say like, oh, we are an extremely ambitious company, that doesn't mean anything. Well, it means different things to different people, right?
Yeah.
So that's kind of ideal. And then you kind of that valuation, and you can think about it when you have those initial conversations of like setting up your proposition. You call them spot meetings, no, quick meetings.
Sneak peek meetings.
Yeah, sneak peek meetings, right? So that's perfect. We should establish that term. It's a
Yeah,
great term for those
yeah.
meetings.
I think I got it from
Um,
somewhere else, but yeah, it's a great term nonetheless.
yeah, and then you get into your 2 weeks of intensity. If you talk with experienced VCs and people that are from the industry, you might not have to bring up valuation too much. But if you are raising an early round and you're talking to investors that maybe haven't done a ton of investments in your sector, they might be used to different practices, different assumptions on growth and other stuff. You might like you have a much more confident idea of where you stand on valuation and where you stand on parameters at that stage. And then after that, when you are negotiating with your lead, you might get to a point where you're knocking heads on valuation. And then the report there can help in kind of unlocking that conversation and saying like, hey, look, nobody knows much about valuation, but we've done our homework. This is like a number that we calculated. Like, what's wrong with it, right? And like, it might allow to unlock that conversation.
Yeah. I think data is power, and having that background research, even when you're right for VCs or good VCs, you kind of want to let the market a little bit tell you what that valuation is.
Yeah,
But if it's in a back and forth, it's great as a founder to be armed with data in different ways, right? So that you can actually negotiate. Because if you don't have that kind of information, it becomes a lot harder to really have a point of view
yeah,
on valuation.
yeah, exactly. And I think that confidence shows, right? When somebody asks, like, if you haven't done your homework, when somebody asks, like, why are you raising this much? Do you think it's appropriate for your stage? Like, do you think, like those type of questions, it's helpful to think them through beforehand. And if you have investors that are not expert in that industry, again, this is mostly like when we're talking about angel stages and so on, but like we get a lot of questions of companies that want to communicate what could be the return, right? To investors that have no idea because they've been only investing in real estate so far, or they've been only investing in like factories or traditional businesses so far, right? So yeah, so having that information comes helpful in those maybe edgier situations.
Yeah.
But even for repeated founders, we have a bit of the same situation. Repeated founders know that valuation is up to negotiation, it's up to the market and so on,
Yeah.
but they want to have a support document. They just want to be done with it in a quick way,
Right.
and we become that quick way.
Yeah. Very, very cool.
Yeah. Awesome. So we're running out of time for today. There's still so many things that it would have been awesome to talk about. Common mistakes, common misconceptions, the whole like how's the US fundraising environment versus the European one, how's AI changing everything. So I think this is a massive teaser for a potential episode in the future.
Episode 2. Yeah. Yeah. Is there any, I have a little bit more time, but is there any like last question or two that you wanted to
I think
ask?
maybe like we can just leave it with like what would be your sort of top advice that you want to get out there for founders that are trying to fundraise for the first time.
Yeah. My top piece of advice is make sure you have a robust story of why should someone should invest in you, right? And maybe the second thing I would say is really treat fundraising like a project and try to pick this several month to 6 month window where you're doing the preparation and execution. And hopefully, from some of the topics we've talked about today, other resources, you can really design it in a way so that you put your best foot forward and give the best chances at running a great fundraise and getting an outcome you're really happy with.
Awesome. Awesome. Appreciate it, Jorian. Yeah, fantastic information. I think fantastic for founders, and yeah, so much more to discuss.
Yeah, thank you so much for having me on. It's really been a pleasure, and always love nerding out about fundraising.
Sounds good. Have a great day.
All right, thanks. You as well.